Hey everyone, I'm David Scranton, and thanks for clicking on this video today. As we talk about bonds and the bond market, so many myths about bonds. It amazes me, but you can find more information readily available about mutual funds, about stocks. But when you talk about bonds, heck, even most financial advisors, unless they're truly an income specialist, can't talk intelligently about bonds. But I want to just uncover some of the mystery now and make it really simple. And in this conversation, I want to talk about investment grade bonds versus junk bonds to make sure you understand the difference. And I also want to talk about this concept called the yield curve. You turn on Bloomberg TV or Fox Business News or CNBC for 2 seconds, and you're somebody talking about the yield curve. Well, what is it? So first, what are the basics of a bond? Well, a bond is basically a contract where you lend money to an issuer, be it a corporation, a municipality, the government. In exchange for that loan, they're going to pay you a fixed rate of interest for the life of that loan, the life of the bond, and it's based upon an interest-only contract. So not like your mortgage where you're paying interest and principal, it's just interest only being paid on a regular basis. Then at the end of the term, 10, 15, 20, 30 years, the principal is repaid to you in a lump sum. It's like a balloon payment. So what are your risks in bonds? Well, your biggest risk, if you're going to hold it to maturity, is that you could have a default. Theoretically, U.S. government bonds cannot default simply because the government can always print money. But municipalities can default. Corporations, of course, can default. We'll talk about this more. We talk about the concept of investment grade versus junk. Okay? But the second risk is if you decide you want to sell that bond before it matures. Now you're not guaranteed to get all your principal back. Why? Because now you have to sell that bond in a secondary market, which means that you need to go out in the stock market and put out the bid and sell it. And you might get more than you paid for it. You might get less than you paid for it. You don't know. And that becomes a bit of a wild card. So those are the two major risks involving bonds, is the risk of the issuer defaulting and the risk of what you might get for it or not get for it if and when you sell it early. So a common question I get is, well, how do bond mutual funds fit into this? Well, bond mutual funds are actually, believe it or not, a riskier way to invest in bonds. Why? Because if you have a diversified portfolio of individual bonds, again, you have a guaranteed interest payment for the life of the bonds. And at some point when they mature, you get guaranteed repayment of your principal. In a bond fund, both those guarantees are off the table. Neither of those guarantees exist. In fact, if you were to study to become a financial advisor, not sure why you'd want to do that, but let's say you did, and you were to look at the definition of a bond mutual fund is actually defined as the stock of a company that owns bonds. I mean, it even sounds riskier, right? So those are the basics about bonds. But now you got to think about, you want to go short-term or long-term, and that's a function of this thing called the yield curve. And then you got to think about investment quality or junk. So let's talk about the yield curve first, because you hear about it so much in the news today. The yield curve is a fancy term, which basically helps describe the difference between short-term interest rates and long-term interest rates. And they call it a curve because it's a graph. It's a graph that has a y-axis and x-axis. And the y-axis is the appropriate interest rate, and the x-axis is the number of years to maturity. So you might have a 1-year bond, a 5-year bond, 10, 15, 20, 30, right? So generally speaking, as you go to the right, as you go out in terms of longer term maturities, the interest you get is going to be higher because you should be compensated for your time commitment. Just like you buy a longer term CD, you make more interest than a short term CD. So the yield curve generally looks like this. It's upward sloping, okay? Now, every once in a while, it gets flat or it gets inverted, and that's a good sign of a recession. When you see long-term rates equal to short-term or long-term rates lower than short-term, that's a signal that the markets are worried about a recession, and they're projecting the Fed's going to push rates down. But let's not worry about that for now. Let's talk about a normal upward sloping yield curve. This is where you want to look at how much extra reward you can get for going from a 10-year bond to a 30-year bond. If it's a little bit extra, you might decide it's not worth it. I want to stay with a short-term bond. If it's a lot extra, you might decide you want to go with a long-term bond. Or if you think interest rates are going to come down, even though you might get only a little bit extra for long-term rates, you might want to lock in that rate because rates are going to come down. I remember even the late 80s when CDs were 10% or almost 10%, everyone wanted to buy short term because they thought, well, the rates of the late 70s, early 80s, 15, 20% CD rates are going to come back. So I'm not going to lock my money up to get 9%, right? Well, in retrospect, if they did that in the late 80s, early 90s, they would have been rewarded. If they had a 20-year CD, well, heck, rates went right down to single digits, and they would have locked in a nice long-term rate, okay? So that's the yield curve, and the yield curve is important in making your decisions. You go short-term, long-term, medium-term. But then the other thing is how much risk of default there is in the bond itself. So, like we said, in theory, government bonds can't default, in theory, because they can always print more money, at least the US government. Other bonds have varying degrees of risk of default or bankruptcy and defaulting on payments. So think of it as a credit score, right? You have a FICO score, I have a FICO score. And if you go to the bank and you have a very high FICO score, and maybe I have a lower credit rating, a lower FICO score, chances are you're going to get a mortgage at a better rate than I'm going to get a mortgage, because I have a higher risk of default in the bank's eyes because I have a lower credit score. But there's different shades of gray here. Just like with FICO scores, the maximum score is 840 or 850. So if you're talking about the difference between a 750 FICO score and a 740 FICO score, it's really minuscule, okay? Well, same is true oftentimes with bonds, but bonds don't have FICO scores. Bonds have, and this applies to preferred stock also, but bonds have different rating agencies that rank the financial stability of bonds. And with most of the agencies, there are 20-some, if not 30-some different ratings, all the way from AAA all the way down to like a D rating. But there's lots and lots of grades. So just like with the FICO score, if you have a higher rating, well, then you're going to pay less interest when you borrow money. So these companies that issue bonds that borrow money that have a AAA rating are going to have to pay very little interest, maybe just a little bit more than a government bond, because the rating agencies basically say there's very little risk of default. If you have a BBB rating, then you have to pay more interest, because the rating agencies will say, well, there's a greater chance that you might default on an investor. Okay? But again, there's 50 shades of gray in here. So when we talk about investment grade versus junk, what basically happened is historically, somebody drew a line, some human being drew a line between two of the 30-some different ratings and said everything above this line is going to be considered investment grade. Everything below this rating is considered junk or below investment grade. So imagine if a banker said, we're going to draw a line at a FICO score of 700. And let's say you go to the bank for a mortgage and you've got a score of 701, and I've got a score of 699. The reality is we're really, really close in our ratings. But if the banker drew a hypothetical line at 700, it means you get the mortgage because you're at 701, I don't get the mortgage, I'm at 699. Well, the same is true with the bond ratings. One rating that goes from the lowest rating above the line to the highest rating below the line really is not that material in the big picture because there's so many different grades of ratings. Okay? And sometimes, for example, an underwriter, if they didn't draw that solid line, might look at me being at 699, and it might be because I had some credit payments that were late. But let's say that mortgage officer dug deep and realized that the reason for this was because I went through a bad divorce. My ex-wife promised she'd make all the payments. She didn't. And as soon as we got divorced, I got caught up and I made the payments. Now you might look at that fact and say, you know what? His 699 is better than the 701 when you look at the mitigating factors. And the same is true oftentimes in the bond world. True income specialists don't just look at the bond rating agencies and their FICO score. They look beyond that. They look at the financials. They look at the reasons. And sometimes they'll find that a rating that's slightly below the line may have that company in an income specialist opinion might have a lower default rating than one that's given a credit rating above the line, slightly above the line. But be able to collect a lot more interest on that one below the line because, again, some human being said this is investment grade and this is non-investment grade. Okay? So again, I want to give you these basic definitions of investment versus non-investment grade, even though that's all they are is basic definitions. And at the end of the day, if you're in the bond world or in preferreds, you need to look a lot deeper than the rating agencies themselves. So pay attention to the yield curve, short-term versus long-term yields, where the sweet spot is where you want to be. and also pay attention to the risks in bonds. Sometimes when the economy is good, a lower rated bond, not a lot of default risk. The economy is strong, people are going to pay it back. Companies are going to pay it back. But all of a sudden the economy turns south, and now even some higher rated bonds might risk default. Why? Simply because the economy turns and even more solid companies could have problems. Okay? So look beyond the credit ratings. I hope that helps demystify bonds a little bit between this yield curve analysis and also the difference between investment grade and junk bonds. I hope this helps.